Morning, everyone. Wow, this is pretty good turnout for Friday morning at 9 a.m. Good thing the bar is closed at 2 in California. Um, today I'm going to talk about decentralized exchanges. And as you probably can imagine, given that I run a centralized exchange, I'm not going to be very bullish on the short and medium term prospects for these platforms. So just a little bit of background, I'm the CEO of BitMEX. We're the largest trading platform in the world for Bitcoin and other crypto coins. And I'm not going to come at this from a technical standpoint because I'm not an engineer or a cryptographer, but mainly from a first principles aspect of what are the problems that decentralized exchanges purport to solve, and are these actually problems that the marketplace cares about? So here's a bit of an overview of what I'll be talking about today. And the first and more important thing is what do traders actually want? At the end of the day, exchanges, we're here to facilitate the ability for people to buy and sell different types of assets. And what traders actually want is really important to providing the solution that actually helps them out in the market. So I've listed 4 things here, and we started in 2014. And back then, the price of Bitcoin, I think when we launched, was about $600. By the January, 2 months after November when we started, the price had dropped by 50% to about $300. And at the time, as with everything, the number one concern with a new exchange on the block was liquidity. How can I get in and out of position? How much does it cost? Are there other people playing in the little sandbox where I am located? And the number one thing that everyone always complained about for our platform, before probably about 18 months ago, was where is the liquidity? There's other platforms that do X, you guys do Y, which is much less than X. Why should I trade there? If you look at the exchanges in probably the top 10, and you look at how old they are in terms of when they launched, you'll probably find that most of them have been around for 3 to 4 years. Even today, it's very difficult for a new exchange to become successful because of liquidity. When you think about, okay, I want to go trade a new asset, where am I going to go trade this new asset? And you think, okay, well, I know that Bitfinex, Binance, BitMEX, all these exchanges exist. They do X amount of volume. I'm going to go trade there. Do you think about the number 20 to number 1,000 different exchanges out there that maybe have launched to do something different, that claim to have better technology, that claim to be more secure, that claim all these different things? At the end of the day, you think, okay, well, this exchange trades $1 billion a day. This other exchange trades $1,000 a day. Where am I going to go trade? The one with the $1 billion. The number one concern for traders is liquidity, always in any market. And so if you don't have liquidity, then off the bat, you're already at a massive disadvantage versus another exchange, regardless of the other features that you claim to do better than everyone else. So once you solve for liquidity, the next thing that a trader cares about is leverage. The most successful exchanges, and we are a product of this, are the ones that offer people leverage, whether that is margin trading, so borrowing from others to obtain the ability to trade more than your capital base, or in a derivatives market, futures contracts where we set the initial margin and the maintenance margin. And if you look at the exchanges in the top 5, you'll see that most of them, if not all of them, have some sort of margin or leverage trading. So internally, when we think about our business at BitMEX, we think about why we're successful. It's the 2 L's, leverage and liquidity. If you have neither of those, there's practically no chance you'll ever be successful in the exchange game. Even in Bitcoin, where anyone can start up their own exchange with a few developers and a desire to be a marketplace. So once you solve for these 2 things, then it comes down to ease of use. What does your UI look like? What is your UX? How easy is it for it to get in and out of position? If I click on the website, how easy is it to deposit money? I'm still flabbergasted about how difficult it is to give people my money when I want to trade on a different platform. I sign up, and I'm like, okay, where the fuck is the deposit page? I want to give you some Bitcoin. I want to trade this shitcoin. It's so difficult to get my money into the exchange just to start trading. Or, how do I do KYC? Why does it take 3 weeks to get verified on a particular platform? I have to submit my proof of address, all these different documents. This all hinders my ability to go from signing up to trading. The easier it is for me to get on the platform and trade, the more volume I'm going to do on that particular platform. And then the last thing is security. I think a lot of people think that security is the number one concern for traders out there, but it actually isn't that important. I was talking with my co-founder and CTO, Sam, the other day in our office, and we were like, well, back when we started, everyone was concerned about proof of reserves, because when we had launched our platform, it was right after MTGOX had gone belly up, and everyone was like, oh, where's the Bitcoin? How are you guys securing Bitcoin? Prove to us that you have all the funds that you say you have. And over the past 4 years, those call to actions for some sort of real-time audit of the Bitcoin that you hold have dissipated. You've had multiple exchanges that have gotten hacked. Some have had very ingenious ways of collateralizing that debt to their users. But at the end of the day, traders just want to trade. And everyone assigns a probability of default to a particular exchange, and they adjust how much money they hold on the exchange accordingly. But at the end of the day, people don't really care about how secure the exchange is, as long as there's liquidity, they get leverage, and they can get in and out of positions very quickly. So once we've solved for what the traders want, what do we as exchanges actually do in the marketplace? So unlike traditional financial markets where you've split up these three functions, in the crypto space, where all you need is a website to start doing business, we as a trading platform perform a lot more functions than usually happens in exchanges. So we're the broker. We have the front-end order management system. We onboard clients. We go out in the marketplace and convince people to come on, sign up, and give us their money. We present them a front end. Some are good, some are bad. But at the end of the day, we are responsible for that particular piece of software. If you're in the traditional space, there is a vendor that has an order management system. Maybe that's your interactive brokers, your E-Trade, your Scottrade in the US. XYZ different bank will offer you the ability to onboard yourself and start trading. Then you connect as a broker to the exchange, where you match trades. Many people call us all exchanges, but we all perform this function and much more. But if you think about, say, the New York Stock Exchange, all the New York Stock Exchange does is match trades. There is no New York Stock Exchange website where you can log on and sign up, send them a bank wire, and start trading equities. And then the last piece is the custodianship and settlements. So we hold your crypto in fiat, we transfer it in and out of our systems, and we settle the trades that you perform on our platforms. And obviously, there's been a lot of focus on this custodianship portion of the market. A lot of people think that, if we solve for the custody issues around crypto, there's going to be more institutional investors who come into our space and start trading, which makes sense. Because in the traditional world, if you have a certain level of assets, I think in the US it's $150 million US, you have to have a third-party custodian hold the different assets that you are trading on behalf of your clients. And if you don't have a regulated institution who is a custodian, then it's very difficult for you to operate as a business. Now, unfortunately, and fortunately, due to the aspects of crypto, no one has a real insured solution for custodianship of assets, which is a problem. Because if you are a large money manager or hedge fund, you have a fiduciary responsibility to make sure that the assets that you are placing on third-party trading platforms will not go, poof, be gone. But unfortunately, there is no insurance company that I've seen so far that's offered comprehensive insurance to insure against the theft and loss of crypto assets. Because at the end of the day, if any exchange owner wants to just up and leave and steal your money, it's pretty easy to do so. There's no bank or any other third-party financial institution standing between them and the money that you have given them. So these are the three things that we, as trading platforms and others, perform in the market. So what is it that decentralized exchanges or DEXs propose as value to the ecosystem? What are they trying to change? So obviously, as I mentioned, custody is a big issue for many people. So one value proposition for DEXs are that clients maintain custody of their funds at all times. So you have most of these platforms are based on Ethereum. You have an Ethereum wallet. You're going to hold your Ether or relevant shitcoin that you want to exchange in your wallet at all times. At the point in which you wish to trade, you will exchange that with the other side of the trade. So it's up to you to maintain the integrity of your wallets. You may or may not want that responsibility, but that is what the DEX is claiming to offer you, is the ability to control your funds at all times. The second thing is that many people are uncomfortable with the fact that trading on an exchange is centralized, meaning that we have complete control over the record of what has happened on our trading platform. Obviously, the big drive in this whole industry is for everything to be 100% transparent, and when you're talking about a DEX, for trading to happen on a public blockchain, which means that I can query when my trade happened, which wallet it happened with, and at what time, and at all times I know that, okay, there is nothing fishy going on. This obviously has pros and cons. All the public blockchains out there at the moment are extremely slow relative to a centralized exchange, which is just moving data in a database. So there's no need for a proof of work or proof of stake or proof of whatever sort of ledger to prove that the trades that I did actually happen. And then the third and very important point is these DEXs claim to be decentralized, so in theory, governments cannot shut them down. So this means you can trade all manner of shitcoins and other dodgy things on your platform, and you as the operator have washed your hands of all responsibility of what happens on your platform. So these are the three things that have excited investors about the DEX value proposition. So why do people actually want to trade crypto? Most traders out there don't give a flying fuck about the technology behind any of the stuff that they're trading. What they care about is that it's volatile. These assets move. Bitcoin moved, 20% over the last 3 days. That's probably the most stable of all of the different assets you could trade. Relevant coins can pump and dump, hundreds of percent in a matter of hours. That's extremely exciting when you come from a traditional equity space where the S&P 500 might move 0.5% in a week. Access. So the majority of people trading these assets are in places where it's very difficult to trade anything other than property and equities. And in most countries, these two things are extremely expensive. Equities on a price to earnings basis, and then property in terms of median income to how much a property costs. But in most jurisdictions, those are the only things that you're allowed to trade. So now when you come to the crypto space and you have thousands of different things you can trade whenever you like, that is extremely enticing for people who otherwise don't have any other means to invest and save. And then 24/7. Obviously, people don't want to trade at a 9 to 5. Usually they're at their jobs working. A lot of people want to trade crypto when they come home or in the middle of the night. And the ability to just open up your mobile app or your desktop and start trading is awesome. So of these three things, do actual traders care about being their own custodian? I don't think so. I don't think your average crypto trader wants to be their own bank. They just want to trade something exciting. They don't want to learn about a new wallet software or how to hold crypto assets. Do they care about a transparent trading infrastructure? No, again, they just want to trade. They don't care about what the exchange is doing on the back end as long as their trades get matched. They own the particular asset that they want to own. A lot of DEXs think that regulators are going to ignore them. So what do regulators prevent exchanges from doing? ICOs. There's a lot of heat on the ICO space. We at BitMEX have shied away from anything related to ICOs given all of the regulatory heat. You can't buy certain coins on certain exchanges because they're afraid that their particular domestic regulator will take issue with that. You have this security versus utility debate. If I allow you to trade a particular coin, is that securities dealing? In most cases, most exchanges do not want to be trading securities because that carries with it additional licensing requirements that they're not particularly willing to undertake. Anonymous coins. A lot of exchanges and the regulators, Japan is one example, almost forbid the trading of coins that are actually anonymous that have security built into them. You think of Dash, Monero, Zcash, these type of coins where the sender and the recipient are just not disclosed. And then complete piles of shit coins. Things that are so shitty that only trade on like EtherDelta, right? Even Binance won't list them. So these are the things that exchanges will shy away from because they just don't want somebody who is so blatantly stealing money from people that they could go to jail for it. So DEXs in theory are decentralized so that a protocol by its nature cannot break the law. But however, DEXs are usually offered by a discrete set of humans. There are people on a website saying, please use my particular protocol. I have these credentials. I know how to code technology. So please, invest in my coin that's used on the platform to pay for fees or my protocol. So if I'm a regulator and I see that there are these people representing themselves on the internet as the developers of a particular protocol, they're the ones upkeeping this protocol, and then people will trust that, okay, if there's something wrong with this particular decentralized exchange, I know that there's these three dudes or gals who I can harass on Twitter or in Slack, and they're going to fix something. Who are the regulators going to fuck? Those guys. So yes, the protocol might not break the law, but there are 5 humans that they can easily put in jail for whatever they feel like. So I think that the notion that a decentralized exchange can do whatever they like and escape the wrath of regulators is entirely naive. And so here's a little bit of chart porn from our research desk. Here are this is July's volumes of the most popular DEXs. IDEX here is number 1 at about $200 million for the month, and we go down the list. The 0x protocol is obviously very popular in terms of building DEXs on top of it. Here's a breakdown of the most popular platforms using the 0x protocol. And finally, this is the total volume of DEX versus versus Binance. So I think I have the wrong chart here, but whatever. The DEXs are a very small percentage of trading of these particular assets, and a centralized exchange is doing a much better job at this function. So again, my thesis is that decentralized exchanges, while are a novel thing that I think might be relevant in 5 to 10 years, in the next short or medium term, they don't actually solve the things that traders want solved. And so investors in these protocols, regardless of the fact that maybe the technology may or may not work, should understand that the fundamental problems that DEXs want to solve, traders don't really care about. That's all I have for you today. Thank you very much.